What if I told you there's a way to collect income from the options market where you know your maximum loss before you ever enter the trade? No surprises, no margin calls, no waking up to a blown account. That's the credit spread. And for traders who value discipline over excitement, it might be the most important strategy you'll ever learn. Let's break it down. A credit spread is a two-leg options trade. You sell one option and buy another option at the same time on the same stock with the same expiration date, but at different strike prices. Because the option you sell is worth more than the one you buy, you receive a net credit. That credit is your maximum profit. The option you buy acts as a safety net. It caps your risk so you know exactly what you can make and exactly what you can lose, right from the start. There are two types. A bull-put spread, also called a put credit spread, is when you believe the stock will stay above a certain level. You sell a put at a higher strike and buy a put at a lower strike. You're collecting premium with a bullish or neutral bias. A bear call spread, also called a call credit spread, is the opposite. You believe the stock will stay below a certain level. You sell a call at a lower strike and buy a call at a higher strike. You're collecting premium with a bearish or neutral bias. Both follow the same logic. Sell the more expensive option, buy the cheaper one as protection, and keep the difference. Let's start with the bull-put spread. Since it pairs naturally with the cash-secured put approach, many income traders already use. Say a stock is trading at $100. You're neutral to bullish. You don't think it's going to drop below $90 in the next 30 days. Here's your trade. You sell the $92 put for $2 per share. You buy the $87 put for 60 cents per share. Your net credit is $1.40 per share, or $140 per contract. Now here's where it gets clean. Your maximum profit is that $140. If the stock stays above $92 at expiration, both puts expire worthless, and you keep the full credit. Your maximum loss is the width of the spread minus the credit received. The spread is $5 wide. That's the difference between the $92 and $87 strikes. $5 minus $140 equals $360 per share, or $360 per contract. So before you enter this trade, you already know you can make $104 or lose $360. That's your risk-reward profile. And the beauty is, you can decide ahead of time whether that ratio makes sense for you. Your break-even point is the short strike minus the credit. 92 minus $1.40 equals $90.60. The stock can drop almost 10% from where it's trading, and you'd still be profitable. Now let's look at the other side, the bear call spread. Same stock, trading at 100, but now maybe it's run up a lot, and you think it's going to stall or pull back. You don't expect it to push above 110s. You sell the $108 call for $1.80 per share. You buy the $113 call for 50 cents per share. Your net credit is $1.30 per share, or $130 per contract. Maximum profit, $100. If the stock stays below $108 at expiration, both calls expire worthless. Maximum loss, the $5 spread width minus the $1.30 credit, which is $3.70 per share, or $370 per contract. Break even the short strike plus the credit. $108 plus $109.30. Same framework, different direction. You choose which one to deploy based on your market outlook. Here's why this strategy is such a game changer, especially for developing traders. First, capital efficiency. A cash-secured put on a $100 stock requires $10,000 in buying power. A put credit spread on that same stock might only require $500. That means you can diversify across more positions, more sectors, and more expirations without tying up your entire account in one trade. Second, defined risk. There's no scenario where you lose more than the width of the spread minus your credit. Period. This makes position sizing straightforward. If your maximum risk on any single trade is $360, and you've decided you won't risk more than 2% of your portfolio on a trade, you know exactly how many contracts you can sell. Third, probability. When you sell credit spreads at the right delta, typically between 0.15 and 0.30 on the short leg, the odds of the spread expiring worthless are in your favor. You don't need the stock to do anything dramatic. You just need it to not breach your short strike. Now let's talk about how to select a good credit spread, because not all setups are equal. Start with the underlying, choose liquid stocks or ETFs, things like TIE, MSFT. Liquidity means tighter bid-ask spreads, which means you're not giving up money just to get into the trade. Next, pick your expiration. The 30 to 45-day range is ideal, just like with cash-secured puts. You get strong theta decay without the gamma risk that comes with very short expirations. Then choose your strikes. The short strike determines your probability of profit and the premium you collect. A tighter spread, say $2.50 or $5 wide, gives you less risk but also less reward. A wider spread, $10 wide, gives you more premium but more exposure. Find what fits your comfort level. Look at the credit relative to the spread width. A common benchmark is aiming for at least 30% of the spread width in credit. So on a $5 wide spread, you'd want at least $1.50 in credit. This gives you a reasonable risk-to-reward ratio and enough room for the trade to work. And finally, always check implied volatility. Credit spreads are a short volatility strategy. You benefit when IV is elevated and then contracts. Selling spreads when IV rank is above 30 or 40 puts the wind at your back. Let's talk management, because entering the trade is only half the job. Profit target. Many disciplined traders close credit spreads at 50% of maximum profit. If you collected $0.40 in credit, you'd look to buy back the spread for 70 cents. Why not hold to expiration and capture the full amount? Because the last 50% of profit takes disproportionately more time and carries more risk. Taking money off the table early frees up capital for the next trade. Loss. A common approach is to close the trade if the loss reaches 2 times the credit received. So if you collected $1.40, you'd close if the spread is trading at about 4.20. This limits your damage and preserves your account for the trades that do work. Rolling. If a trade is going against you, but you still believe in your thesis, you can roll the spread to a later expiration and potentially a more favorable set of strikes for additional credit. This gives the trade more time to work. Rolling is a tool, not a crutch. Use it selectively. Assignment risk. If your short leg goes in the money near expiration, you could be assigned. For put spreads, that means buying shares. For call spreads, that means selling shares. The long leg protects you from catastrophic loss, but it's still cleaner to manage or close the trade before it gets to that point. Here's the bigger picture. Credit spreads let you generate income with less capital, less risk, and more flexibility than many single-leg strategies. They're the backbone of many professional trading operations. Hedge funds run them, market makers run them, and individual traders who approach the market like a business, not a casino, run them too. You can use bull put spreads as a capital-efficient alternative to cash-secured puts. You can use bear call spreads to lean against resistance levels or overextended rallies. And you can combine both, selling a bull put and a bear call on the same stock at the same time to create an iron condor, which profits from the stock staying within a range. We'll cover that in a future video. Let's recap. A credit spread involves selling one option and buying another for protection. You collect a net credit, which is your maximum profit. Your maximum loss is defined from the start. Bull put spreads profit when the stock stays above your short strike. Bear call spreads profit when the stock stays below your short strike. Choose liquid underlyings, 30 to 45-day expirations, and strikes with favorable credit-to-width ratios. Manage at 50% profit, cut losses early, and always know your numbers before you enter. This is trading with structure. This is how you build consistency. If you found this helpful, subscribe. More strategies are coming. We're building something methodical here, one video at a time. See you in the next one.